Welcome to 3 and 3. Today we're going to be talking about Fed rate cuts, municipal bond taxable equivalent yields, and barbelling your bonds. Thank you for joining us for 3 and 3. So Fed rate cuts. So in July, the Fed opened the door to a rate cut, especially at the September 17 through 18 session. On August 21st, the Labor Department solidified this by saying that the U.S. economy created 818,000 fewer jobs in March than originally reported. That's the largest revision since 2008. And if you look at inflation, the Fed's favorite preferred measure has actually tumbled from a peak of 7.1% in 2022 to now 2.5% and is trending toward the 2% target. The trend definitely supports a rate cut in the near term. And the question is not if the Fed will actually cut, is actually when and by how much. So we're looking at payroll revisions, and you can see that 818,000 jobs that was lost. And that's a tremendous actually support now for the Fed to look at potentially a 0.25 or even a 0.5% cut here in the September meeting. So municipal bond taxable equivalent yields is a way to compare returns of tax-exempt municipal bonds to actually taxable bonds like corporate or treasury bonds. Munis are often exempt from federal income tax and sometimes state and local tax too. This means you keep more of your actual earnings. To fairly compare a municipal bond yield to a taxable yield, you need to account for the tax savings. So for example, if a municipal bond yields 4% and your marginal tax rate is 25%, then your actual yield on a taxable equivalent basis is 5.33%. So that means, again, a taxable bond would have to yield 5.33 to be the same after-tax yield, which a municipal bond would offer at 4%. So as you're looking here at this chart, it's showing the taxable equivalent municipal yield versus the 5-year average. And you can see that AAA 10-year municipal bonds are actually pretty good value right now. And if you're willing to take a little bit more risk, you can see the BBB munis and high yield munis also offer a very competitive rate over the last 5-year comparison. So barbelling your bonds. So barbelling your bonds refers to a strategy where an investor divides their portfolio into two distinct groups. You've got the short-term bonds and the long-term bonds. By combining the stability of short-term bonds with the potential for higher yields and price gains from long-term bonds, investors create a more diversified and potentially resilient income portfolio. Currently, the belly of the curve, which is between 6 and 10 years, is the most expensive part of the curve, meaning a barbell strategy, the front and the long term, probably offers the best advantage from just a price perspective. And as you're looking at this chart, you can see, especially in the AAA general obligation bonds, the front end of actually the curve is very inexpensive. The belly is, again, where you're seeing some expense, and the long-term offers value also. And looking at, again, U.S. Treasuries, you can see the same somewhat comparison. So we would say a barbelling strategy right now makes a lot of sense. Thank you for joining us for 3 and 3.